Buckle up, because in the realm of cryptocurrency, the difference between exhilarating victory and nail-biting anxiety is often just one unexpected headline away. Not too long ago, market observers everywhere were stunned by murmurings that Bitcoin might plunge all the way down to 92,000 in a shockingly brief span. Yes, you heard correctly. Some speculated about a dramatic drop that could send ripples of panic through both seasoned investors and curious newcomers. So, what is fueling these sudden surges in pessimism, and how could it affect anyone who has even a passing interest in digital assets? Today, we are going to delve into the swirling tempest of global events, from heightened tensions in the Middle East to the ever-watchful eyes of the Federal Reserve. We will explore how these influences may or may not guide Bitcoin's next big move, and we will also peek under the hood at what some traders are calling signs of an oncoming alt season. Will Bitcoin defy the skeptics and soar to unprecedented heights, possibly beyond 200,000 in the year 2025? Or are we witnessing the first signs of a broader market stall that could leave everyone guessing for weeks or months on end? Stay tuned, because we are about to pull back the curtain on this fascinating and ever-evolving drama. You might be asking yourself, why should I care about some seemingly abstract market predictions or the chatter about altcoins? Well, here's the thing. Whether you are a day trader hoping for those short-term gains, a long-term investor who has tucked away a modest Bitcoin stash for the future, or even just a curious bystander who wonders how global headlines might influence digital currencies, the dynamics of the crypto space have real-world effects. The price of Bitcoin, after all, is not merely a theoretical figure on a chart. It can reflect, and indeed can be influenced by, various macroeconomic forces, including foreign conflicts, shifts in monetary policy, and the subtle interplay of investor sentiment. It is a barometer of risk appetite, global trust in decentralized assets, and the evolving relationship between technology and finance. Today, we are going to unravel exactly how these global pieces fit together, forming a mosaic of crypto volatility that has everyone buzzing. The first headline to tackle is the swirl of tension emanating from the Middle East. In recent weeks, a handful of startling international incidents and diplomatic frictions have captured worldwide attention. Market watchers nearly held their breath as oil futures flickered upward and certain stock indices whipsawed with uncertainty during one weekend that featured especially heated exchanges. The immediate reaction for Bitcoin was equally swift, with some observers speculating that the leading cryptocurrency might serve as a hedge in times of potential conflict. Then again, the subsequent cooldown in prices hinted that traders might not be factoring in a protracted confrontation just yet. The question is, have we all become desensitized to these geopolitical headlines? Or do markets believe cooler heads will indeed prevail? One telling signal is the rate at which prices for oil, gold, and certain other safe haven assets revert to their previous levels, sometimes within mere hours, and how Bitcoin's volatility calms in tandem. Some might see this as evidence that the prospect of a permanent extended conflict is not currently embedded in pricing. But here is something that adds a little spice to the entire situation. Some analysts caution that even if heightened tensions feel fleeting, any spark in the region could set off more unpredictable price responses in the future. After all, each new bit of news coverage contributes to an undercurrent of general unease, and a large segment of traders watch for the slightest hint that global instability might become entrenched. If that happens, ironically, Bitcoin might see an uptick as a perceived safe haven alternative, even though many still argue that the currency is too volatile to play that role consistently. This leads us to a bigger question. Is Bitcoin truly on the verge of establishing itself as digital gold, or is it still too young and unpredictable to lay claim to that status? We will explore exactly how that debate might evolve in the coming minutes. But first, let us take one step deeper into the macroeconomic realm, as the next big factor that could sway Bitcoin is far closer to home for those in the United States. Enter the Federal Reserve, which has an outsized influence on the global financial ecosystem. For some time now, the Fed's decisions regarding interest rates, quantitative easing, and other policies have reverberated through equities, commodities, and currencies alike. Despite some hopes that inflationary pressures might dissipate, we have seen the United States wrestle with the consequences of earlier expansions of the money supply. To many in the crypto world, a looming question is this: how will the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, shape the conversation about further rate hikes or cuts. The Federal Reserve Chair is scheduled for multiple testimonies in front of key lawmakers, and the slightest hawkish or dovish tilt can send shockwaves throughout the financial sphere. A rate hike, for instance, can tighten liquidity and push some investors out of riskier assets. Conversely, any sign of monetary loosening might rejuvenate the appetite for Bitcoin and other cryptocurrencies as participants hunt for yield in more venturesome markets. If that were not intriguing enough, we must note the complicated political backdrop in Washington, D.C. Some have even pointed fingers at the current administration, accusing them of leaning on the Federal Reserve to adapt policies that could quell inflation more quickly, perhaps by pushing interest rates higher. Is that rumor or reality? It is difficult to say with certainty, but speculation alone can spark flurries of activity among traders who obsessively study every word uttered by Federal Reserve officials. Meanwhile, supporters of a more dovish approach argue that too many hikes risk stifling economic growth just when the economy is trying to find its footing. That tension naturally spills into the crypto market, especially given Bitcoin's identity as a decentralized alternative to government-backed money. How might all these cross-currents manifest in the near term? Will a perceived policy error by the Fed blow fresh wind into Bitcoin's sails, or will it dampen the already delicate sentiment hanging over the crypto sphere? We will seek to paint a clearer picture. Before we go any further, let me offer a quick, friendly reminder. If you find this deep dive into global conflict, Federal Reserve intrigue, and Bitcoin's ever-shifting momentum fascinating, consider adding your support right here and now. A simple action, like sharing this piece or giving it a thumbs up, can go a long way in helping more people discover these insights. It also encourages us to continue unearthing the untold details behind the headlines. Thank you in advance for your engagement. Moving on, we come to the heart and soul of this discussion: Bitcoin's own technicals and on-chain signals. Lately, market participants have been engrossed in talk of Bitcoin testing new lows, specifically in the region of 98,000, and then perhaps heading even lower to 95,000. That might sound like mere speculation, but it becomes more tangible when you look at exchange order books, which often reveal pockets of liquidity where large buyers might be lurking. Some analysts have pointed out that a notable cluster of buy orders has surfaced around that mid-90,000 zone, indicating that if the market does head south, it might rebound quickly thanks to demand. Others, however, warn that if these buy walls get absorbed amidst panic selling or unexpected news, then the slope downward might be steeper and more jarring. Interesting, right? But what is behind these potential weak spots in Bitcoin's price? One explanation is to zoom out and notice that short-term holders, those who have only been in the market for up to 6 months, are grappling with heavy unrealized losses. This kind of data is often gleaned from on-chain analytics, where platforms such as Glassnode or CryptoQuant track how recently certain addresses have accumulated their coins. If a substantial share of the new investor cohort is underwater, they are psychologically more prone to panic. A single negative development could prompt them to dump their holdings and cut losses. On the other hand, some believe these corrections are par for the course. After all, if the market has been drifting higher since the start of the bull run, a pullback to reset overbought conditions might be exactly what the doctor ordered, setting a healthier foundation for renewed upside in the months ahead. Let us also consider what might happen if Bitcoin does indeed drop to the low 90,000 range, or even below that. Some are calling for a bounce at around 92,000, as if that is the new magic number. Skeptics say that if the bottom truly fell out, we could even see the mid or high 80s. But the real debate is, would that be the end of the bull story for Bitcoin, or would it simply create a bigger coil that sets the stage for an explosive rally toward the six-figure territory once the dust settles? Historical patterns in cryptocurrency certainly suggest that each bull cycle is punctuated by local corrections, some of which can look severe in the moment, but in hindsight, merely shape the next leg of growth. The short-term noise might obscure the longer-term uptrend. Alternatively, if the macro environment takes a turn for the worse, say with a deeper global recession or a major escalation of conflict, those negative forces could overshadow even the most compelling on-chain data. Meanwhile, in the realm of altcoins, a different kind of drama is unfolding. For many months, Bitcoin's dominance, that is, Bitcoin's share of the total cryptocurrency market capitalization, had been ramping up steadily. This often means altcoins underperform in comparison, as traders flock to Bitcoin's relative safety, or perceive it as more stable during uncertain times. Now, though, that dominance has inched toward a level historically known to trigger a reversal. Some analysts point to prior cycles and say, look, whenever Bitcoin's dominance nears 70 or 71%, it tends to correct, paving the way for altcoins to shine in a phenomenon we call alt-season. Will history repeat? Or has the crypto landscape diversified so much that the old patterns no longer hold? The alt-season hype is alluring. It conjures images of dramatic triple-digit surges for some of the more popular alternative coins, from brand-name platforms that focus on decentralized finance to lesser-known tokens that might boast a new angle on blockchain technology. But let us not forget that altcoins carry their own unique risks. When the entire market pulls back, many of these smaller-cap tokens can nosedive at a pace that is even more alarming than Bitcoin's fluctuations. The faster the drop, the sharper the pain. Even so, a handful of savvy traders see this environment as an opportunity. They argue that if Bitcoin's dominance indeed shows signs of peaking, then rotating some portion of one's portfolio into fundamentally strong altcoins could be the golden ticket that yields a spectacular return when the pendulum swings the other way. Of course, the operative phrase here is fundamentally strong, which is sometimes easier said than done in a market brimming with hype, quick cash grabs, and short-lived euphoria. This brings us to yet another thread, the year 2025. Mention that date, and you will often hear bold proclamations about Bitcoin's price potentially reaching 200,000 or even higher. Why 2025? Well, by that point, the next halving will be in the rearview mirror, historically giving Bitcoin a shot of momentum as the block rewards become more scarce. On top of that, many believe that mainstream institutional adoption of cryptocurrency will be more robust, providing a more stable foundation for growth. Could it be that we are now witnessing the early innings of the bull cycle that leads into 2025? That is exactly what some watchers are suggesting, pointing to the cyclical nature of the market. But not everyone agrees that a six-figure Bitcoin is guaranteed. After all, plenty of unforeseen events could derail these ambitions. A deeper recession might hamper demand. Regulatory changes, particularly if they are abrupt or restrictive, could scare large swaths of institutional capital away. And if the Federal Reserve reverts to a more hawkish stance for longer than expected, we might see suppressed risk appetites well into the foreseeable future. Then there is the possibility that Bitcoin simply meanders sideways, failing to attract widespread buying interest if, for instance, the broader sentiment is uncertain, or if too many participants are fixated on short-term trading. Some even posit that the market might break historical precedent, charting a new path that defies old cycle patterns. Interestingly, on-chain analysts have tried to cut through the endless speculation by focusing on metrics that measure not only investor sentiment, but also the real flow of coins between addresses. They track data on how many addresses are in profit, what percentage of the supply has not moved for extended periods, and which addresses are doing the bulk of the selling or buying. One highlight is the short-term holder realized price. Historically, Bitcoin has often bounced at or near this metric, underscoring that short-term participants frequently capitulate right around the average cost basis of their holdings, marking a valuable pivot point for the next move. But is that pattern set in stone, or might a wave of exogenous shock break it? The ongoing tension in the Middle East, the Fed's announcements, and the general unpredictability of global markets all have the potential to disrupt these seemingly reliable signals. Yet the bull case remains compelling for a lot of enthusiasts. They point out that even if trading volumes slow in the immediate term, the upcoming expansions in payment technology, the emergence of more user-friendly crypto platforms, and the relentless drive toward institutional acceptance might converge sometime soon. If so, we could witness a scenario in which renewed capital floods into Bitcoin, lifting it beyond the widely anticipated 100,000 threshold, then continuing to ascend to that coveted 200,000 figure by the year 2025. This scenario is not just a pipe dream for the devout faithful. Some banks and financial firms have teased that a major shift in capital allocations is only a matter of time, as more fund managers treat crypto as a new frontier for portfolio diversification. Will they pour billions into Bitcoin, setting off a scramble among altcoins as well? It is a question that could be answered sooner rather than later. What about the darker side of speculation? While many of us prefer a future of adoption and stable growth, It is no secret that cryptocurrencies have also been dogged by controversies. Hacks, revelations about money laundering, and contradictory regulatory statements have all hovered on the periphery, shaping the risk profile. A single, major negative event, say, a catastrophic exploit on a major exchange, could devastate sentiment in ways that overshadow even the most optimistic on-chain data. Still, the resilience of the community is remarkable. After every stumble, Bitcoin has, historically, rallied back, eventually surpassing old highs and forging new ground. That unstoppable aura, combined with the track record of cyclical expansions, is perhaps the biggest reason some watchers double down on bullish predictions, even when gloom appears to dominate the immediate narrative. Of course, none of this is investment advice. Rather, it is a guide through the labyrinth of factors at play, from global politics to local monetary policy, from altcoin mania to the inevitability of supply and demand economics. There is a reason that tens of millions of people watch crypto news with near-obsessive interest. It is not just about profits and losses, but also about a new chapter in human commerce, one where decentralization and autonomy might reshape everything from remittances to how we store value across borders. The question for each of us is how to position ourselves in this unfolding story, or whether to participate at all. Before we wrap up, let me slip in one more gentle invitation. If you find yourself captivated by the questions and possibilities we have just explored, from potential diplomatic standoffs to Federal Reserve curveballs to the fiery momentum of alt-season, go ahead and subscribe if you wish to follow this journey more closely. By doing so, you will always be in the loop when new developments break, and you will help drive further analysis that peels back the layers of crypto's most intriguing mysteries. Thank you for your continued support. So, where do we stand right now? As we venture into the final stretch of the year, the consensus among many analysts is that Bitcoin hovers at a crossroads. On the one hand, lurking fears of fresh lows in the mid to high 90,000 range remain, especially if short-term holders succumb to panic or if a macro bombshell knocks investor confidence. On the other hand, glimmers of hope suggest that the overall structure points to a long-term ascending trend that eventually might catapult Bitcoin into six digits. The altcoin market, meanwhile, could either languish under the weight of Bitcoin's dominance or stage an electrifying comeback if dominance does indeed peak soon. And for those who dream of the next major milestone, 200,000 or beyond by the year 2025, there is at least some historical context to back such optimism, provided that world events do not throw too many obstacles in the way. Ultimately, part of what makes the crypto space so exhilarating is that it sits at the nexus of cutting-edge technology, global finance, and mass psychology. When big announcements or tensions surface, the ramifications can be swift and extreme. That is why stories about sudden dips, improbable rebounds, and altcoin surges can captivate even those who are not actively trading. We might read about the Middle East conflict in one headline and see an immediate correlation with oil and stock futures, only to watch Bitcoin respond moments later. We shift our gaze to the Federal Reserve's remarks on inflation, suspecting that a more hawkish stance could siphon liquidity out of speculative markets, and lo and behold, prices shift accordingly. Meanwhile, obscure altcoins rise from obscurity, snapping up attention, then slide back into the abyss whenever traders chase a different storyline. It is a perpetual balancing act, one that is unlikely to settle into predictable normalcy anytime soon. As you absorb all this, keep in mind that the crypto market's triumphs and stumbles can be fleeting. Being nimble, whether in your perspective, your research practices, or your risk management, remains paramount. The road to 200,000, if it happens, may demand patience and nerves of steel. The rumored meltdown to below 90,000, if it comes to pass, could test the willpower of those who might panic sell at precisely the worst time. And the Middle East conflict, as well as Federal Reserve policies, might tilt from focusing on short-term threats to revealing deeper, longer-lasting shifts in global economics. Through it all, Bitcoin stands as a symbol of defiance against traditional finance, an emblem of hope for those who seek alternatives, a source of endless frustration for those who see no fundamental value beyond hype. In the end, you have to decide what resonates with your worldview. Are you among those who believe that Bitcoin's cyclical expansions, historical chart patterns, and inherent scarcity are setting the stage for an eventual leap to unprecedented heights, particularly by the year 2025? Or is this an overheated market on borrowed time, ready to deflate once the macroclimate sours. The truth, as always, might lie somewhere in the middle, with the final outcome shaped by an evolving dance of innovation, conflict, regulation, and human psychology. One day, Bitcoin might be heralded as the unstoppable force that upended centuries of centralized finance. Another day, it might be labeled as a fad overshadowed by more tangible concerns like geopolitical stability and climate threats. The dynamic is never static. Whatever the case, if you have made it this far, congratulate yourself. You have journeyed through the maze of tensions in the Middle East, the labyrinthine corridors of Federal Reserve decision-making, the enthralling possibilities of altcoins, and the compelling but uncertain predictions that could usher Bitcoin beyond 100,000, or eventually even 200,000, by the year 2025. Perhaps the biggest takeaway is that no single voice or chart can definitively predict the future, because the crypto universe depends on an eclectic mashup of technology, headlines, and individual choices made by millions of participants worldwide. So, as we close the curtain on this exploration, remember that uncertainty does not negate opportunity. It is, in fact, the environment in which every major financial transformation has ever taken root. If that resonates with you, then Bitcoin and the broader crypto space might well be worth more than a passing glance. The potential for dramatic innovation, game-changing disruption, and, of course, risk has never been higher. It is a grand stage where each new act could redefine the direction of monetary history. Will it be a triumphant ascension that carves out new dominions of wealth, or a cautionary tale that echoes the booms and busts of eras past? Only time will tell. In the meantime, stay alert, stay curious, and keep an open mind, because this electrifying ride is far from over.